So welcome back. And for our second session for today and for the final session of the conference, we're now going to look at the investment landscape and most promising tech sectors for investment. Now, following our earlier deep dive conversation into the three sectors that we've been assessing through the conference, internet services, high-tech manufacturing, and just now FinTech, our Anderson alumni investor panelists will address where they see investment happening in these sectors and what they find most promising. Now, this discussion is going to be moderated by Chris Tang, Distinguished Professor and Edward W. Carter Chair in Business Administration at UCLA Anderson. He's a foremost scholar on global supply chain management. Exposure to real-life industry projects motivated his academic research, where he developed teaching cases on a variety of topics, such as microfinancing for the poor, mobile platforms for developing economies, and new business models in the age of the internet. World-renowned in his field, he's been a consultant to numerous companies, including Amazon, HP, IBM, and Accenture. He's also published 6 books and is a frequent contributor to the Wall Street Journal, Barron's, the Financial Times, Fortune, and China Daily. For this session, as with the others, we're allocating time for audience Q&A. Please use the Slido function, which is embedded at the bottom of your screen. You can either enter in your own question or upvote one of the existing ones. Please join me now in welcoming Professor Chris Tang.
Good morning, Asia, and good evening, USA. Thank you very much for having me, and welcome to this session focusing on the investment landscape and the most promising tech sectors for investments in China. So please join me in welcoming our 3 distinguished panelists who are all our UCLA Anderson alumni. So let me just say a few words about them, and then before I turn it over to have our discussion. Our first panelist is Fritz Demopolis. Fritz has over 20 years of experience as an investor and entrepreneur in Asia. He founded China's largest travel platform, Qunar.com, and China's largest digital sports medium company, Shaowei.com. Currently, he is an investor at Queen's Road Capital. The second panelist is Danny Chin. Danny is a partner at the Yuanzhan Capital Management. He's also an expert on advanced hardware and enterprise software as a service, SaaS, startups in China. Last but not least, we have Sam Sun. Sam is the managing director at the Affinity Equity Partners and Sequoia China before that. Sam has made many cross-border buyout investments in industrial, technology, and healthcare sectors. More importantly, Sam was one of the organizers for the first Wilbur Wu conference some years ago. Now, before I begin our discussion with our panelists, let me begin with some observations about U.S. investment in China and in the U.S. Now, over the years, China has reformed its political and foreign trades and investments. Economic liberation is at the iterative process, but it is no secret that the climate between the US and China has changed a little bit. There were talks about decoupling, even though the economy between the United States and China is intertwined, or some may say symbiotic. Now, then the question is decoupling a real thing? Let's look at the number. In 2020, a total of $163 billion investment flowed into China, and 80% of the investments, they were from the United States. Second, China's resilience on the coronavirus and its high-yielding assets attract a lot of investment in foreign investments in stocks and bonds. So last year alone, there was an increase of 62% in overseas holdings of local stocks and bonds, which amounts to $520 billion. On top of that, the import of goods from China in the US actually at the all-time high at the end of 2020. And yesterday, China just reported its phenomenal economic growth of 18.3% in the first quarter. So therefore, there is really no empirical evidence of decoupling at this point. Now, putting politics aside, let us learn from our panelists about the change of the China and cross-border investments landscapes, especially in the technology sectors that are really hot, as we learned for the last few days. So let me start with Fritz. Fritz, as an investor and entrepreneur in China and Asia for a long time, can you share with us about your journey?
Professor Tang, thanks for having me. Sam, thanks for initiating the Wilbur Wu conference many years ago. So it's great to be here. I graduated from Anderson in 1997, and I was at that time interested in technology, the internet, and of course international. And when I was graduating, I was presented with various opportunities. Two were in Europe, and one was in Seattle. You can imagine that company, and a couple in LA. But then the most interesting opportunity for me, and the one that paid the least, was to move to China with News Corporation. And so I moved to China in 1997, right? Literally 2 weeks after graduating. And I thought I would be there for 2 years, and it ended up being 15. And I've been 24 years in the Asian region. And like Chris, like you said, I realized I wasn't a good employee. That happens sometimes. I would encourage every Anderson student to consider whether they're really a good employee or not. And I wasn't. So I thought the only way I'm going to make my dent in the universe is to set up a company. So I set up my first business in 1999. And back then, SoftBank was even active in those days. And they were my first investor, along with Intel Capital and IDG. And I grew that business. And I was involved in a few other projects, including Kunar, which is as you mentioned, a travel company. And the last 8 or 9 years, I've been an investor in Asia, doing things in China, but investing in other places as well. And Chris, I wanted to throw out something. I remember 25 years ago when I took your class, and you said one of the reasons that attracted you to pursue your career at UCLA was the interdisciplinary opportunities to work with professors in different departments and functions. And that's something that I always remembered, because as an entrepreneur and investor, it's something that I always think about as the interdisciplinary approach to solving problems and obtaining insights. And so thanks for those words of wisdom 25 years ago, and I still remember them.
Thank you so much. This is really heartwarming, and thank you. Now, so you was really pivot from employees to entrepreneurs to investors. So now let me turn to Danny. Now, Danny, you are in the private equity and venture capital space. Can you share with us, how do you create value for the Chinese investors or investors like Fritz?
Sure. I actually graduated from UCLA Anderson in 2011, which is a fascinating time for venture or even for PE investment in China. Because after 2008, the big recession there, basically it's hard for a Chinese student to find a local U.S. job. At least that's how I feel. And then I teamed up with a couple of my Anderson graduates who is 2010, and we started our own journey of investment. We first did a pre-IPO round, which kind of give us the reality, give us a very hard lesson. Because in 2 years, the IPO windows totally shut down. And then we kind of took the opportunity at that time to switch to venture capital investment at that time. And luckily, our first like a major investment is in a drone company called a DJI, which gave us like a phenomenal return, like in a couple of years. And then it is still a amazing company. So for us, I think how to provide value to our investors is to find a kind of a good company or even good team to start with, and like help them and work with them so that we can create a fantastic company in the long run. Because as for venture capital, our time horizon or investment horizon is relatively long, which is at least 7 to 9 years. At that time, it was unbelievable in 2011 or even 2014. But right now, most people believe that. So that we hope that with our help, then we can create value with the help of time.
Thanks so much, Danny. This is really refreshing. When you graduated in 2008, when life gives you a lemon, make lemonade. So that's how DJI really makes a big difference. This is a fantastic story. Now, Sam, I know that you know private equity. Is there something you'd like to add to what Danny has just said?
Hi, good morning and good evening to the US. Before I start, I'd like to take just maybe 1 minute, if you will permit, to talk about the Asian hate that's happening in the US. I'm a Chinese American, and it really upsets me to see the cowardly and vicious attacks against Asians in the US. But really what saddens me is, seeing the people, the bystanders doing nothing, and seeing Asian Americans forced to justify why we deserve to be in the US and why we are as American as any other. I've seen veterans coming out and say, I'm Asian, but I've served in the military. I've seen healthcare workers come out, saying that I'm Asian, but I, work on the front as a healthcare. All that, is great that these people are contributing to the society, but it saddens me that we have to prove to people that we deserve to be there. So I like to ask everyone who's, attending the conference and hearing this to condemn not just the violence, but the thinking that Asians don't belong or Asians need to justify our Americanness. We are as American as anybody else, and that should not be questioned just because our skin color or our origin of our birth country or anything else. So having said that, I have graduated from UCLA in 2007. Prior to that, actually, I worked in the technology sector. I was a computer science undergrad and worked in the technology sector for 8 years and opened my own business in China. Prior to joining Anderson, I ran my own business for 2 years and then sold that and came back to school. At that point, I was thinking I should do venture capital because, technology background with a startup experience, that's the right formula. But, I find myself drawn to the more mature side of the investing business, the later stage companies and mature companies. And in China, that is something that's actually a very small part of the finance world. Most of the finance world in China right now is venture capital and growth capital. What I like about that is, you can really get deeply involved with companies you invest in. You talked about high-tech manufacturing, but if we look at overall manufacturing in China, it is a huge part of the economy, and China is manufacturing base of the world. But many of these manufacturing industrial companies are fragmented, subscale, and run inefficiently. They were competitive based on cheap labor rates, based on kind of a price competitiveness. But that's no longer the case. So a lot of the companies we invest in, we push the company to strive to become more efficient through, manufacturing process. A lot of things, Professor Tang, you taught in classes. Optimizing supply chain, optimizing operations, implementing automation, putting in technology, not just to save, cost on labor, but also improve quality of their products. So I think, as a later stage investor, what we really focus on is how we bring value by doing the daily blocking and tackling of the business. Not very glamour. I've stayed in factory floors for a few months at a time trying to improve the operations. But at the end of the day, it's very satisfying when you see, you taking a company from not 0 to 1, but 1 to 10, or maybe even 10 to 100.
That's really excellent. First of all, I want to thank you for speaking up and speaking out about the hate crimes against Asian Americans. Actually, I moderated the session this afternoon. And then the conclusion is I think the Asian Americans need to really stand together to have a solidarity to communicate to the external community that we are your brothers, we are your sisters, we are your neighbors, we are your educators, we are your bankers. So you don't need to like us, but don't hurt us. It's not too much to ask for. So I fully agree with you. Now, coming back to your comments in terms of private equity, I think it's fantastic that you actually help the company to become more efficient, more productive, so that they reduce costs and improve quality. This is music to my ear. Thank you. Now, before we get into which technology sector we should invest, let us clear the air about the climate. Now, so I'm not going to let Sam run away yet. Now, 10 days ago, Bloomberg was just reporting that there's a surge of financial investments in stock and bonds in China. But now Chinese government may be worried about the outflow because when the investment going in, it may come back. But then if a sudden outflow of capital, there is concern about devaluation of the RMB that they have observed in 2015. Now, let me ask you, Sam, do you think that this kind of situation would create some kind of unstable transactions or frictions or regulations that would make people nervous? What's your take on that?
Yeah, I think number one, any investor who's investing, foreign currency into China needs to be aware of this potential restriction. China does have a capital flow control. So money in and money out, both ways are controlled and monitored. So that there is a certain risk. And a few years ago, Chris, when you mentioned that, when there was a sudden devaluation of the RMB, especially at that point, it was a lot of Chinese nationals, Chinese companies and Chinese nationals transferring money outside of China. And that caused the government to come down really hard on the capital flow. And one of my investments was impacted. I had invested in the JV in China that, as a US dollar investor, we transferred a large sum of money into the JV. But we did that to acquire a foreign company with the JV. So ultimately, the money needed to come back overseas to make the acquisition. Now, that process was delayed by several months because of the capital flow controls. Now, we were impacted by a few months, but at the point, and at that time, we were never worried that we was not able to complete that transaction. Because, China, despite all the rhetoric, you hear here and there, China is determined to be integrated into the world economy, right? We're not talking about ideology, and there are differences in ideology, but from an economic perspective, China is not going back. And so, they just needed to slow down the capital flow. They needed to make sure that, all these money being transferred in and out are for legitimate business purposes. So yeah, we were impacted, but we weren't worried that, our money was going to stuck in China forever. So, be aware of the risk, but don't be scared that you're never getting your money out. And also some recent developments are encouraging because they've now, clarified how Chinese individuals can transfer up to $50,000 a year outside of China to invest in securities and other things. So I think they're making progress on how to, separate these legitimate transactions versus these, just trying to, the capital flight, so-called.
Thank you. That is very comforting. Danny, was there some comment you'd like to add to Sam's response?
I think in terms of the capital flow, that there is definitely a slowdown in terms of how, more importantly, like how Chinese investor money goes to do direct investment in the overseas company. Because I remember when we first did our overseas investment, at that time we had RMB inside China. And then we would like to invest in companies in the Silicon Valley. And that was a quite relative, like an easy process. We only filed to the relevant government, and in 2 months, the money was transferred to US dollar, and then we invested completely. And now, there was a time it was even impossible. But now I think it still takes time, but it is showing signs of relief, or like we can still do that, do the ODI, the so-called ODI, overseas direct investment, but it's not as easy as 6 years ago, but it's not like as difficult as probably like 3 years ago. So that's the experience I have.
Thank you. Now, let me come back to you, Fritz, because now you are still considered a foreign entity, right? So in the case, do you have any concern about getting money out if you want to?
No, I don't have any concern. I mean, we've seen for 20 years, it's almost like the tide, it ebbs and it flows in terms of your ability to get your money out of China, or frankly, to bring it in. I remember there were periods when everyone wanted to invest in China because it was hot, and so we see these periods back and forth all the time. I think, as an investor in any, market that's not your own, we have to think about how much money we allocate to those markets, and that there is going to be some risk. But, generally speaking, I think directionally things look favorable. But yes, currency controls, and there's some legitimate reasons for it, and there's some other reasons that are a little bit unclear to all of us. And the way I think about it is we just accept it. But from the period of history, we've seen it be easy. Sometimes it's hard. It's almost like a pendulum. And so I'm pretty confident that even if there are tight restrictions that are implemented, it's going to go the other way. I think the one thing to add, though, is that currency restrictions do lead to asset price distortions, and that's reflected in sometimes the insane real estate prices that we see in places like Beijing, which can be higher than New York City and places like that. And so we have to kind of be mindful of those distortions, and what does that mean for local investors as well as foreign investors.
Thank you. Thank you for sharing your perspective about in terms of potential risk, but it's manageable risk in terms of inflow and outflow of capital. Now, let me just get to the key points in terms of the investment in the technology sector. So let me just make a remark about the backdrop. Last year, in May 2020, the Politburo actually established the dual circulation policies. There's the internal circulations based on high-tech manufacturing, because the 2025 Make in China initiative, and also in terms of advanced sciences. Then there's an external circulation more on the international trade as well as the digital RMB. Now, given this backdrop, let me ask you then, Fritz, in terms of the three technology sectors we have been discussing over the last 3 days, in terms of FinTech, internet services, and high-tech manufacturing, given this backdrop, which sector is more promising and why?
From my personal perspective, I think, let me just comment on all three. But I think internet services, broadly speaking, I think are still the most promising. for a couple of reasons. There's still a lot of things that need to get done in China. And what's interesting about internet services, that's primarily governed, owned, managed by private sector enterprises, whether those are foreign enterprises or Chinese enterprises. And anything that's more private sector versus state directed tends to be more entrepreneurial, meets the needs of customers, flexible. And I think that's one of the reasons why we see a flourishing of interesting startups and concepts and companies. And so to me, super excited about that. FinTech, I think anything that's finance related kind of reminds me of what a friend of mine from Anderson said many years ago. He said that, financial services attracts 2 or 3 types of people: really smart people and really evil people. And sometimes they're the same. And meaning we see a lot of opportunists and there's, I think that's led to some potential, instability. Yes, it's big. Since the ancient Sumerians, 4,000 years ago, financial intermediaries and traders have probably captured 1/3 of all economic value. And so I think it's about time that shift back to the people. And but I would be slightly less optimistic only because of potential regulation, those smart and evil people participating in the market, things like that. Advanced manufacturing, that I like. What we tend to see is investment tends to be more focused on B2C. Only recently have we seen an upsurge in B2B investment and entrepreneurship. And to me, I think there could be some interesting opportunities there. I think the challenge is that requires some unique domain knowledge, and for example, materials, heavy industry, energy, those are all very much controlled by the state. And so that provides, I think, an extra set of challenges for entrepreneurs and investors.
Thank you. I think that is very timely, in particularly in the context of FinTech. Basically, your comment is that the internet services or the high-tech manufacturing, those are more safer investments, because FinTech, we don't know in terms of the transition, in terms of regulations, especially in the context of how and financials is transforming itself. Now, let me ask Sam then, in terms of, do you agree with Fritz's analysis about these 3 sectors? And if you to pick one, which one will you pick and why?
Yes, I completely agree with Fritz's analysis. I think the consumer, right? China has 1.4 billion people. So the consumer-facing side of the business is always easier to get off the ground, because even if you capture just a small percentage of that population, you still have a pretty successful business. The finance side, I think most people know that Alibaba's subsidiary Ant Financial was recently stopped from being publicly listed in both Hong Kong and China. That regulation came out in a pretty dramatic way, right? With Jack Ma making a public statement, criticizing the government regulators, and 2 days later, that imminent IPO was, postponed, indefinitely postponed, right? So that was pretty dramatic. But I feel that regulation itself was reasonable, and it was necessary, because the Ant Financial was heavily levered, and it was packaging consumer loans and then selling that off as asset-backed securities. And if you look back in history in 2007 and 2008, that's part of the reason why we entered into a global financial crisis in the U.S. and the rest of the world. So excessively packaging these financial debt or assets and then reselling these, and also lending to subprime, sub-quality borrowers are very dangerous. And that's why the Chinese government came out with certain regulations and asking them to provide additional capital, reduce their leverage, et cetera, et cetera. So I think I agree that in the finance, especially the FinTech world, there are a lot of regulations, already in place or or will be coming to place. So it's hard to predict what's going to happen. So you need to be more careful. And my personal favorite is the manufacturing, the high-tech manufacturing. To give you an example, I've always been a industrial investor. But to give you an example of what's happening today, 2 days ago, I was visiting a factory in the western part of China. They are setting up a new manufacturing line to manufacture flexible glass. Samsung and Huawei and all come out with foldable phones. But if you had looked at one or bought one, these phones don't look that good because the screen looks flimsy. And the reason is that they cannot use glass to cover the screen. So instead they use plastic. And plastic don't look as good as glass, and it gets scratched easily. So this company is a Chinese company. And they have state-of-the-art technology to reduce the thickness of the glass down to 0.03 millimeters. And they are able to sandwich that glass or treat the surface so the glass is sandwiched with two harder surfaces and a soft core, so it can be bent. This is not a copycat company. This is not a substandard product company. This is a leading edge company that's going to support the global revolution of next revolution of personal PDAs or personal communication devices. And you're seeing more and more and more of that in China today. Backed by manufacturing technology, backed by research, and backed by huge consumer market. So I think that's where I like to invest, and that's where I think a lot of opportunities are.
Thank you. Very good analysis. So now in view of time, I'm going to change the topic a little bit to Danny. Now the two experts, they're saying that, FinTech is too risky. And then Sam said, hey, high-tech manufacturing is the safer bet and also more promising. Now, but then in China, in view of the internal circulation and external circulation, then these startups companies are doing glass or drones like DJI and some other startups. They have a choice, either focusing on the domestic markets or the global markets, right? So for you, in terms of if you are advising an investor, should they focusing on startups, they focus on domestic markets because now there's an internal circulation that the Chinese government is promoting, or you would favor the startups actually go for the global market? Which is your pick, Danny?
Okay, well, I think I will give you an answer probably you will hate because I will say it depends, right? Because I used to hate that answer so much that I always hope there's one answer for that. But here I would say, because it depends on the company you invested, or it depends on the team you've invested. Like what we learned from Anderson School, all these the Porter matrix. We need to find out what's the competitiveness of each individual team there. Like some are really good in terms of tackling the domestic or the Chinese market because they are so fierce, because they are so competitive, because they can improve the supply chain so much that they're the price taker or they're the price competitor in that market. But some are good at marketing on the building a story which is really popular in the US or in the Western world. And then they can leverage, they don't have to be perfect in supply chain management, but they can build a good story and they can sell their stuff in the overseas market with a very comfortable margin. And these are the teams that I see they can just go tackle the overseas market. And if you switch those two teams around, probably they're going to be like a dead in a couple of years. But you have to, they will find a way to find the best market, the product market fit for themselves.
Thank you. Well, wow, your response is like a professor teaching the class, like the Michael Porter's framework 2x2. It all depends, of course, absolutely. So it depending on the competitive advantage, whether the startup is focusing on the domestic market, has a really differentiating value, or the global market. That's really fantastic. Now, give me time. Otherwise, I can really talk to you for the entire day. Now, let me move on to the next question before open up to the floor for other questions. Now, given your expertise, now we know that in terms of your ranking would be like in terms of high-tech manufacturing, internet services, and then FinTech, right? Knowing this and also the backdrop of the current event, can you share with us what kind of advice will you give the audience about investing in China? So let me start with Sam. What kind of advice will you give to the audience about investing in China?
I think the key word I will give is localize. That has many facets. Number one, you need to understand the local situation, the culture, the motivations of local government, and etc. It's hard to come from the U.S. and say I expect everything to be the way that they are in the U.S. or come from Europe and say I expect everything to be the way they are in Europe. You need to localize yourself, adapt to the local market. And to give you an example, I was meeting with some local government officials, and they impressed me very much. They were very professional. They had agenda all prepared at the day ahead of the meeting, and they brought all the necessary different department heads to meet with me to talk about potential investment targets in their region. And when I identified one of these as interesting, they were able to arrange a meeting in the same day, right? And these are the level of services and level of efficiency that you don't see in the U.S. But on the flip side is, if you don't understand their motivations, if you don't understand what is in there for them, you might go in there offending them, and they might take a very passive or even passively aggressive approach to you. So I think number one, you need to localize yourself as an investor, and number two, you need to localize your investments, right? The kind of echo what Danny said. You need to have a management team or leadership team that is fit for that local market. To helicopter in somebody who doesn't have that local context normally don't end up well. So I think that's my advice: localize, localize, localize.
Thank you. So in terms of localized knowledge and they have a clear understanding about the markets as well as the government, I think is crucial. Thank you for the advice. Fritz.
I think many of us are familiar with Moore's law, which is, the microprocessor doubles every 18 months. Its processing power. And I think there's something called Moore's law of knowledge, where your knowledge just has to double every 18 months. It's super practical, but to be a successful investor, to be a successful entrepreneur in China, you just have to double your knowledge about consumers, the government, key tech trends, investment regulations every 18 months. And that means being curious, open, networking, talking to people, reading, attending conferences like this, bantering. And I think to be competitive, frankly, in probably anything one does, they have to constantly be learning and doubling their knowledge. And so, that would be my advice and of course, how do you do that? Well, unfortunately, you probably have to move and maybe give up some of your friends and family, but that's fine, because that's how you're successful too, is you got to dive right into right into the arena and figure it out and be aggressive and smart. But of course, it's super exciting at the same time.
Thank you. Well, you really confirmed Sam's advice. Helicopter coming in would not work. Yes, thank you. Danny.
Yeah, I agree both with them. And also, I would say, find the right team. That's what I would give the advice. Just note that I'm not saying finding the right person, but nowadays you have to find the right team, because I think one person can move very fast, but a team can move very far.
Oh, wow. That is very philosophical. The team, the diversity, and also in terms of knowledge will really help you to go farther. That is wonderful. Thank you. So this is exactly the time we're going to turn over to our audience. So they have submitted some very interesting questions. So I'm going to share with you. The top question is by Chen Lei. So basically the question is, how does the investment division of Tencent and Alibaba change the landscape of technology investments? In terms of how Tencent and Alibaba change the landscape of the technology investments in China? Let's start with Fritz.
I guess I'd make just two small comments. I think Tencent is extremely inspirational. I think they're one of the most successful tech investors globally, and so it's just an inspiration to see that. But it's true that the large conglomerates have invested in a bunch of companies, and of course, one of the prices that you have to pay as an operator is to be stuck within their ecosystem, which may be good and maybe not. And so what we see is, sometimes like the large Alibaba, Tencent, and some of the other conglomerates kind of require loyalty or fealty to, the specific ecosystem. And I suppose that could, there's a lot of pressure, I guess the anti-monopoly laws and regulations, and of course, Alibaba has recently been fined on that. And, this is part of that, I think. And so I think the conglomerate, and keep in mind that historically, the conglomerate model, and these companies are conglomerates, of allocating capital have been extremely efficient in very dynamic periods and less efficient when there's more steady growth. And I think the reason why Tencent and Ali have done so well in the past is because China is a very dynamic market. But I think as the market evolves and becomes a little bit more stable, I'm not sure the conglomerate model of asset allocation is going to be as effective and efficient as maybe individual investors and or venture firms like Sam's firm or Danny's firm.
Thank you. Maybe Danny, do you have any remarks to add to it, or should I move to the next question? Danny, your choice.
I just add one more thing. I think we would like Tencent and Ali, or maybe now Meituan has also going into these like investment arena per se. The more players, the better. And it just for us, we don't like players with no ground rules. But for those companies where they're more established, they know the rules, and we would welcome these type of investment new entities.
Thank you. Now I'm going to ask another question. This is a question for Sam. This is a question from our FEMBA students, Ryan Hayes. Now, this is the background goes as follows. A few days ago, China is the first country that introduced the sovereign digital currency, actually managed by the People's Bank of China. So this is really a big news. So in the context of like a One Belt, One Road initiative, cross-border investments, how would that change? So here's a question. How do you see the development of the digital RMB will be impacts the cross-border movement of capital in and out of China? Sam, what's your view on that?
First of all, I'd like to say a caveat that I'm probably not the most knowledgeable of the digital currency world. So the way I will see this is from a kind of a macro perspective. It is great for the overall kind of the digital currency industry, because we're seeing more and more governments starting to adopt that technology and adopt that idea. And the Chinese government, of course, I think their motivation is not to have the digital currency run wild, without their supervision or control. So they came out with their own version of it. Whether it will be successful or not, it's hard to say. That what typically when the Chinese government set their mind on something, they make it happen. But there are also scenarios when when the product is very much market driven, and they don't really compete that well with market oriented companies. For example, UnionPay is a government backed company, and for a while they competed really well, right? They competed with Visa, MasterCard, etc., and they took a lot of market share. But when Alipay and WeChat Pay came out, and they started to take market share, and right now, I don't know the exact numbers, but I definitely use WeChat Pay more than anything else. So it's hard to say. In this particular case, I think given that is a currency and it has a lot of regulations, I think it's likely that the Chinese digital RMB is going to be a significant player in this space. And I think the Chinese government's goal is actually to tightly monitor and control cross-border currency or capital flows. So I think they will probably more likely than not achieve that goal.
Very good, thank you. So I think that you're right. The digital RMB, I think that at least at the minimum is actually create the traceability of capability to prevent money laundering and also maybe the under table dealings. So I think that is a healthy first step. Then in terms of global trade, I think it's too early to tell. So I think we'll see in the future. Now, moving on. So this is an interesting question. It's from our full-time MBA alumni. And the question is anonymous, so I don't know the name. So this person said that we heard many positive development in China during this conference. Then the question is that there must be something that is risky to invest in China. Which sector is risky to invest right now? Danny, what is your take? What are the risky investments that people should avoid, if there's any?
For me, I don't see any risky investment. For us, we always consider the risk return profile. If there is a very risky, your price or your investment, like a capital should be justify that. But since the economy or the investment is pretty hot these days, the one thing I saw that's kind of making this risk return profile unfavorable is the valuation is getting really high right now. I still remember when we first started investing in China and in the US, a startup team with only ideas, a pitch book, or probably 3 or 4 guys. We usually value them at 10 million RMB, but right now their start is going to be 100 million RMB. So that's the one that we see.
Okay, no risky. Fritz, what you take? Is there any risk, any investment you avoid yourself?
There's obviously a lot of risk, right? It's kind of like, I think the way to think about it is, no one is suggesting put all your financial assets and all your time in China, right? Well, what we're saying is certainly let's allocate some of your financial capital and some of your time to China but obviously, like any good portfolio manager, and keep in mind, a portfolio manager is also managing their time and also an individual, right? You can have some China experience and some Europe experience and North American experience or whatever. So I think that's important. So I would say, yes, there's always going to be risk. And keep in mind, I think that our understanding of the risk in China might be a little bit, because China's so dynamic, sometimes we don't really quite understand it. The weighted average cost of capital, that all the bankers use to evaluate assets in China seems to be maybe lower than what it should be. Who knows, right? I think we can debate that. And so maybe there's some misunderstanding on what risk means. But so I would just take, that macro perspective. Yes, there's some very, very specific areas that either, foreign versus Chinese, Chinese owners are going to be preferred. And then there's also some categories where it's the state versus the private sector. And let's keep in mind, the biggest challenge we have investing in China is not this idea of China versus foreign, it's state versus private sector. That's the much bigger challenge. And entrepreneurs like Jack Ma and Sam and myself and Danny and all of us, that's what we think about more is like, God, if the state-directed conglomerates get involved, then it makes it much more challenging than, this notion of China versus foreign, which is all, like you said, everything is so coupled, it's kind of blended and no one really knows what that means anyways.
Absolutely, because the supply chain is really intertwined, it's interconnected between US, Europe, and China. Now, so here's another interesting question. Before I ask the question, let me give you the background. That I work on global supply chain and been looking into U.S. China trade relationship in the context of global supply chain. So this year, there is a survey conducted by Ghana Group, the consulting firm. Out of close to 2,000 executives were surveyed, 87% of the respondents, they're saying that, they're going to diversify their supply chain. They're going to diversify the supply chain, so that's maybe diversify the risk. So in that case, just in case, some of the operation may shift it away from China. It could be reshoring back to US or shift to other countries such as Vietnam that we've seen it actually has been rising. So here's a question from our full-time MBA student. The name is Singo. Here's a question. I said, do you expect the foreign investments in manufacturing sector, including the high-tech manufacturing in China, is going to reduce as international firms try to diversify the supply chain? So maybe ask Sam.
Right. I do think that, first of all, I agree that we need to diversify our supply chain base. We've seen it from the beginning of the pandemic. When China was shut down, there's a shortage of all sorts of goods. But we also see that when China is back online, and when the rest of the world is shut down, and for much longer period of time, China carried a lot of the weight of the global supply chain. And if you work in the sector, you will know that it's hard to find a container in China right now, a shipping container in China right now, because there's not enough goods coming back to China, but a lot of goods coming out of China. So what we learned from that is that you can't put all your eggs in one basket. It's not safe to have all your supply chain in China, but you can't take it all out of China either. So on that background, I don't think that the investment in the manufacturing in China is going to be significantly reduced. What we see is a lot of both the multinational and Chinese companies divesting their supply chain. We've seen a lot of Chinese companies going to Vietnam, Southeast Asia, Eastern Europe, and even the US. But at the same time, we also see a lot of investments in China to upgrade the supply chain, and coming up with new products and et cetera, and international companies and the domestic alike. So I think it's a balance. I think we're probably going to see more investments into the consumer, less investment into the manufacturing, but it's not a complete, large reduction or a complete, outflow.
Okay, thank you. Danny, do you have other comment to add to Sam's response?
Yeah, I just would like to add on Sam's response is what we are doing, or what our Chinese fund is doing, is basically helping these new entrepreneurs upgrade their supply chain or even manufacturing capacity, or making products in terms of the automobile industry, autonomous driving, robots alike. So there's a shift and there's an upgrade.
Great. Thank you. So I think that this is because I'm in this space. So I really think that because the Chinese government now, they have the dual circulation, the domestic market is huge in terms of the manufacturing sectors, because they understand the manufacturing sectors would employ a lot of people still, and also they can keep the country stable in terms of economy stable. So I think that I don't think you're going to slow down anytime soon, right? So moving on. Now, we know that is really surprising after the hiccups of the Ant Financial IPOs. Then all of a sudden, Alibaba was fined for $2.8 billion because it is now China's do think about the antitrust law in terms of monopolize the market is not good. Then, of course, Alibaba is now taking corrective measures to help the merchants to become more successful. So given this background, we have a question from our FEMBA students, Shantanu Kumar. So his question is that given that the government has fined Alibaba, how is it going to change the landscape of the startups? Because if even Jack Ma, Alibaba get fined, then would that really raise a concern about people being an entrepreneur to startups? So I will start this question to ask Fritz.
I don't think anything is going to happen, to be honest. I mean, there's so many startups and entrepreneurs, and you ask anyone in China and 90% of the people think they're going to do better than their parents, right? Which is probably the inverse of most other Western countries. And now, I mean, there is an issue of, are there regulations that might affect how companies are formed, access to capital, how companies are operated? I mean, maybe, but, regulations and policies and all that sort of stuff, those are just hurdles that have to be overcome, right? And just make sure your best friend is a Chinese lawyer. And like, if you look at my wedding pictures, you'll notice the guy who spoke at my wedding is my Chinese lawyer. And it's super important to, be able to, navigate, kind of the Chinese system. And so, I mean, I don't think, I wouldn't read too much into that. And, and frankly, like a lot of people forget, yes, it's probably true. There were some anti-competitive practices, but it's kind of funny to kind of think, I mean, we see so many ruthless competitive practices in China. It's like, oh, you mean Alibaba was the only one? I mean, there's a bunch of them, right? And frankly, that's just part of the job. That's what we, which is why China is a super fun place. It's of course you could be pummeled, but at the same time, it's super exhilarating. And so maybe, and this is probably, I think, for the realm of the China scholars and the China watchers, and there's other reasons too, kind of for that fine. And, and well, I don't want to be someone who can read the tea leaves there, but, when Jack Ma, for example, met President Trump after his election, it wasn't the ambassador, right? It was Jack Ma, and I don't know if that grated anyone like a few years ago. And there's a range of other things. I mean, meaning this is a complicated issue, and that fine, I don't think reflects prevailing policy whatsoever. I think there's other things going on there.
Okay, no one knows, because you said it right, how to read the tea leaves. It's very complicated issues. So Danny, do you have any points to add to Fritz in terms of the episode of the finding Alibaba?
Oh, I think in terms of like a venture investing, right? Like if you are fined by the government, for early investors, you should be happy, because now you are so big that the government notice you, right? I don't talk about for those people who wanted to go into the pre-IPO round, but like if you are the Series A investor, Series B investor, and if your name is on the central TV, or your name is gonna be being fined for $100 billion, you're well off right now.
Absolutely. I know in China, if you were being paid, get the government's attention, you must be very successful, right? So let's not worry about at this point yet, right?
Yes, exactly.
Very good. Very good. Now, so let's moving on. If you have time,
Professor,
yes.
if I may just add one point, I think when the fine came out, I think we heard a collective sigh from the larger companies because it was only a monetary fine, not any kind of structural reforms, mandated on these companies. So people now, the larger companies, the Alibaba, the Tencents, the JDs, they all think that, okay, now I know I can pay for a fine. It's just cost of doing business. I think the practice, those monopolistic practice will continue. So the smaller companies, I'm not sure they're going to be so happy about it because, I think Tencent and Ali and JD and PDD suck up most of the internet traffic in China, right? For a lot of these kind of, smaller companies and TikTok, for a lot of the smaller companies now they still have to incur a very high cost of acquiring those traffic. And they still have to play within these guys, kind of monopolistic rules. So it may not be a good thing for the smaller companies, but for the big companies, I think they are kind of sleep better, for the next few months.
Oh, you're absolutely right. Because after the ruling came out, Tencent immediately invited government officials to advise them how to comply with the new regulations. So they're very smart, they're very happy. Now, let's move on to the last question, if you have time. Well, if you think about that in terms of right now, everyone is thinking of investing in high tech, in technology, and also in China and all this. Now, this is a question from Jieru Sun. The question is given this, everyone is investing in technology, IPOs and whatnot, and some may see it as a bubble. Do you foresee there's a technology bubble on the horizon? So what is your view on that? Because we've seen the bubble burst in the past. So is there any risk? Is it how likely would that be? Let me start with Danny.
Yes, I absolutely agree with the bubble theory right now. It's crazy, especially in the Chinese early stage VC market. You've heard the stories about how to get a deal, how to invest in a deal that's highly pursued by all the big names you can hear, and also is it used to be, for example, Sam's old fund Sequoia. They used to do these Series B, C, D, and all these larger ladders, but now they're going into even venture or kind of a very early stage. And there's a rumor, I wouldn't say the name, but one of the big CTO coming out of a well-known consumer electronics company. And before he decides to do anything, his company is already valued at 200 million, a US dollar, right? So the guy, it doesn't even know what he's going to do next, but he's already get investment. So in this sense, there is a bubble, but the bubble is still in the early stage, I would say. Right now, I see it's a relatively high compared to last several years, but it can be the COVID, it can be a lot of things, and the money printed by all the central government, be it in U.S. or China. So there's going to be some bubble there, and right now I think it's still a healthy bubble.
Well, thank you. That means that there may be some risk there, but we're not quite there yet. Fritz, is there any additional point you'd like to add to Dennis?
Yeah, I mean, I would just say that, I mean, we have to accept the fact that there is going to be cyclicality, right? We haven't solved it, right? I mean, this time is different. That's what people, of course not, right? We're going to see some ups and downs. And I think that the best way is we just have to have a consistent approach, right? Sometimes we're investing in the bubble, and sometimes we're investing in a trough, no big deal. And And statistically, the best investors are those that have a very consistent pace of allocating their capital, not trying to predict when the bubble is and going all in too early or too late. And I think that's the best we can hope for. And I mean, like you asked a lot of people a year ago, did you expect the markets to be this way? No, they're actually, everyone thought the markets were going to be horrific. And next thing you know, they're the other way, right? And so, I mean, we just have to accept the fact there's cyclicality. I mean, I guess, like Danny said, healthy bubble. I mean, that's a new word, but I mean, I'm gonna have to use that, Danny. But I think what we do, as opposed to trying to predict it, of course, like if you can predict it, just set up a hedge fund quickly, right? But in the absence of that, I think we just have to be consistent in how we allocate capital, and sometimes we accept the fact that that entrepreneur gets a $200 million valuation for doing nothing. And sometimes it's going to revert the other way. And in a super capable team, you're going to have a very low valuation because the market's bad. And we're going to invest in teams too.
Okay. So Sam, I let you have the last word on these issues. Is there a bubble?
Yes, I think we're definitely worried about the asset valuation levels. I think the question to us is, I completely agree with what Fritz said. The case can be made that a investor's return is maximized when you consistently deploy capital through the troughs and peaks. So the question you got to ask yourself is, what kind of investor am I? Am I going to time the market, or I'm going to just stick to my principles? I think for us, we're going to stick to our principles. We're going to consistently deploy capital. And the difference is today how we look at the companies, right? At a high valuation market, we are going to look for high growth, high quality companies. Because if you look at these slow growth companies, they're not at a valuation level. Right, you're not getting them cheap. You're not getting them below 7 times or 10 times EV/EBITDA. Now, but if you're paying a higher multiple for a fast-growing company, you're probably losing a year or so of your time to create return. But the company, if it's growing at 100%, it will grow and catch up on that valuation. But if the company is growing at 3% or 5%, it will never grow enough to catch up on that valuation. So during this market, our focus has shifted to looking at higher growth companies at a higher valuation, right? A 10 times growth company is not going to have a company that's growing at a 10 times of the other. It's not going to have a 10 times valuation multiple of the other, right? So the thesis is that, you could pay 2 to 3, maybe even 5 turns more, but that's 25% more higher valuation, but the growth could be 100% more, 200% more.
Thank you so much for sharing your wisdom with all of us. In your time, I'm going to wrap up before I turn over to Professor Kramer. So I learned tremendously from your response, from your comments, and so let me just summarize just a few key points that I learned from you. Well, just like any other investment, you investing in China, of course, there's risk. There's no risk investment if you want good return. So, but then the question, how to manage the risk. So I think I learned from you is in terms of looking at high growth right now, maybe in certain sectors. So that you suggest that maybe the high tech manufacturing is more promising. But then even with the investment, you need to have a team, have a really understanding about the local markets, the government structure, the culture, the trend, and also to be flexible. I'm Chinese myself. In China, I kept on telling a student, if you're not flexible, you will not survive. Because no one knows what tomorrow holds. So you have to learn to be flexible, to be adaptive. So in that case, one type of strategy would be managing a portfolio of investments. So in that case, you don't put all your eggs in one basket. Could be China, could be outside China, could be one sectors, could be other sectors, and also have a team to manage the risk. So in that case, that would be a better balance. So I think after all, at the end of the day, it's about how to manage a balanced portfolio of investments. Now, so I think that's what I learned from you. I want to take this moment in time on behalf of UCLA Anderson School to thank you for the privilege of your time to share your wisdom with us. So if you have time, I'm going to hand the floor over to Professor Kramer for his final conference remarks. Thank you.
Good. Hey, Professor Tang and Danny and Fritz and Sam, just a big thank you. I've been taking all these notes, just all the learnings that have happened here. So a big thank you to you. And I think it was a good way to finish the conference. And what I'd like to do now is take a minute to share my own takeaways from the week and to think about what are the things I'm going to remember a month from now, a year from now, and beyond. I'll try and give my best shot at kind of the highlights here. The first thing that I wanted to highlight here is this idea about the pace and magnitude of change that we're seeing in the Greater China region. The sectors that we've picked out are large sectors. The rate of change that's happening is huge. A little bit what Fritz was just saying about, double your knowledge every 18 months. When we look at a lot of the services that are being discussed, and whether it's, blockchain and whether it's certain types of healthcare applications, they're changing rapidly. The second point that I took away is about the role of technology and AI themselves. And I'm thinking about some of the quotes that we had from earlier in the week. AI is the next electricity, which came from Kai-Fu Lee. Eleanor Leong, who said, everything will be AI in the future. And then this kind of third piece that Derek Lee had shared and Florian had shared that said, when you're in these database businesses, they have a self-perpetuating nature to them that allows them to build on their offering, to create better insights, to create more scale. That has ironically created some of the questions about antitrust, but that's a fundamental nature about the data. Third point is about the unique context in China and the idea about large domestic market, willingness to share data and try new services, the core technology capabilities resident there in AI and a bunch of other areas, and this entrepreneurial spirit and competitive spirit that create a high bar for success. Fourth point is the point that Eleanor has raised and a variety of other speakers have raised, that China is no longer following the US, but is leading the world in many areas. So fifth generation networks is an example, mobile payments as an example, where more and more the US and the rest of the world are looking at what's happening and saying, how do we think about our own future innovation? A fifth takeaway is the use of technology for societal gain. So the discussion about AI in education, AI in financial services, AI in healthcare, that in many cases is eliminating income divide, rural divide, et cetera, and how important technology can be for society itself. A sixth comment is about Foxconn and Foxconn's transformation, what it's done to keep itself relevant. And I thought the three areas that they highlighted, given their scale as a business globally, says a lot about their belief in innovation. Their three items, again, were electric vehicles, digital health, and robotics. Very interesting to hear them call out those three items. A couple of other items that came out today primarily. The idea about that came out in the FinTech session about consumer trends and the idea about point of care and service, that people are not necessarily going to want to go to a bank. They're not going to want to necessarily go to a doctor or a clinic, that more and more service provision should come to us. And that often is going to be via a smartphone or some other form of technology. The idea about blockchain and blockchain creating new financial asset classes and creating more broad access to assets. When you think about the entire value chain and lending to farmers and lending to a variety of sources and the enabling access that blockchain provides. And then two or three last items here. In the last panel that we had, this idea about this Where are the best prospects for investment? So high-tech manufacturing, because of the scale and the fundamental nature of high-tech products. Internet services, because much of it is dominated by private enterprises and the opportunities those represent. And beware and watch out for FinTech, that there can be some interesting things there, but because of the reliance of financial services in the broader economy, that if that goes bad, if something goes wrong in lending, in financial capabilities, et cetera, you could have a knock-on effect in society that would be untenable. Couple last items here. The points that were raised again by the last panel about the importance of the competitiveness of the team. And I think Danny raised this about that idea that we tend to get very focused on, the technology, the product, the growth rate, et cetera. Don't forget the power of the team, and great talent, great teams can do great things in difficult environments. And related to that, the point that Sam made about localize yourself, the point about being flexible, and Fritz's point about you need to double your knowledge every 18 months. That certainly is a big message about continuous education and continuous learning. Final comment was the number of regulatory issues that were raised. In technology, we tend to talk all about the products, the services, et cetera. Probably because of the penetration of these services, now they're drawing the awareness of regulators. The future of work, when Kai-Fu Lee said that potentially 30 to 40% of all jobs will either be changed or go away in the next 20 to 30 years, amazing message. Messages about antitrust. So the comments that Renew made about 90% of a lot of the mobile payments is owned by two players, Tencent and Alibaba, and that the focus on antitrust there may ironically create more opportunities for entrepreneurs. Another regulatory issue discussed, data privacy. So with data privacy, Kai-Fu Lee raising the comment about his own personal story about cancer and the need to share data so that medical research can advance. The same point that David Yin made at Mindray, saying, are we really capturing enough data, or is it all so localized that we've missed opportunities, especially in areas of healthcare? It raises the broader spectrum. Have we balanced on the spectrum appropriately about what data is being shared and what is not being shared? And then final regulatory comment is about blockchain and the need for the government to back the transactions there. So a government kind of protection to ensure that technology takes off. Let me just say a huge thank you to a bunch of people that made the conference possible. I want to start out with our speakers and our moderators. We're only as good as the insights that they bring to all of us. And so I wanted to thank all of them for what they've done. And in almost all cases, all of our speakers were in the Greater China region. So a special thank you for that. I'd like to thank our gold sponsor, which was Cathay Bank. I'd like to thank our silver sponsor, which is Landsea Homes. And then there was a variety of partners that worked with us to ensure this would play out well. The Los Angeles World Affairs Council and Town Hall, the Greater China Chamber of Commerce, Los Angeles, the UCLA Asia Pacific Center, the UCLA Center for Chinese Studies, the Easton Technology Management Center, and then a variety of student organizations. UCLA's Chinese Students and Scholars Association, UCLA Anderson's Greater China Business Association, and a variety of other groups at Anderson. I'd also like to thank Michael Wu and the Wu family because they had the idea, the vision, and have supported this conference over the years, and specifically have supported the focus on technology-based innovation with this year's conference. I'd also like to thank my global immersion students. They did a lot of research that helped empower and enable our moderators to think about what are the most important issues to cover during each of our sessions. I'd like to extend a very special thank you to the Center for Global Management. This is Lucy Allard and her great team. They are the ones that organized this. They made sure everything came together. They brought all of our speakers together, and they really did a great job of kind of advancing this into technology content. I'd also like to thank our computing services group. This was all virtual, as you know, and they had to bring all this together to create the sense of connectedness in a virtual environment. As Dean Bernardo mentioned, when he did his opening comments on Monday, he said in normal times, I would be returning with a group of students from travel to Shenzhen and Hong Kong. And we're feeling very fortunate that all of our speakers were willing to join us in this virtual mode and create this type of learning, even in a virtual setting. Obviously, technology is big for every single sector. As we mentioned, fundamentally, technology is changing consumers, enterprises, and it's changing society itself. Let me just say in closing, a big thank you to all of you that have attended. Students, faculty, alumni, members of industry, all of you bringing your engagement makes this event so special to us. A big thank you. We will look forward to seeing you at future events. We'll look forward to seeing you at next year's event. And please stay well. If you're in the US, have a great evening. If you're in Asia, have a good day. Take care.